Nvidia momentum reversal likely. Wait for dips before adding. This article was written by Juxtaposed Ideas. Summary. No matter the export bans, Nvidia's inherent CUDA leadership in the AI boom cannot be ignored, as observed in the robust FQ1 2026 results and the promising FQ2 2026 guidance. This is well supported by the growing adoption of Blackwell, despite the overheating issues and the hyperscalers' intensified custom AI accelerator efforts. Despite the maturing growth profile, NVDA remains compellingly valued compared to AVGO, with the market likely big enough to accommodate multiple players. We believe that the stock continues to offer rich double-digits upside potential from current levels, despite the recent recovery by plus 52.5% from April 2025 bottoms. Even so, with NVDA's buying momentum already faltering, we believe that another dip may be coming, presenting a great dollar-cost averaging opportunity for the patient. NVDA remains attractive despite the recent recovery, thanks to its market leadership in the AI accelerator CUDA segment. We previously covered Nvidia Corporation, Nasdaq NVDA, in March 2025, discussing how the DeepSeek-induced sell-off, the bursting AI bubble, the potentially intensified tariff war/chips ban, and the uncertain macroeconomic outlook had already triggered a massive market-wide sell-off. On the other hand, we had believed that the correction had been overly done as the stock traded attractively below historical levels, and its peers then, aided by the excellent prospects in 2025/2026, as similarly observed in the management's promising guidance and the tailwinds from Blackwell ramp-up, NVDA won Y stock price. Since our reiterated buy rating upon a moderate retracement, NVDA has indeed pulled back to our buy zones of 90s ranges during the worst of the April 2025 meltdown, worsened by the new H2O-related export license requirement to China. This development is unsurprising indeed, given the risks arising from the rerouted NVDA chips to Asia, with $61.35 billion, plus 100% year-over-year, or the equivalent 47%, minus 3.1 points year-over-year, of its FY 2024 revenues currently at risk, worsened by the supposed lost access to the China AI accelerator market, which we believe will grow to nearly $50 billion. For now, thanks to the 90-day tariff pause ending early July 2025 and the ongoing de-escalation in the trade war between China and the US, it is apparent that NVDA's recent correction has been temporary, as the wider market rebounds by plus 19.6% and the market sentiment surrounding the semiconductor sector recover. This is significantly aided by numerous cloud providers, AI SaaS companies, and data center REITs signaling the durability of the AI-related boom during the Q1 2025 earnings season, with it lending support to NVDA's high-growth cadence ahead. The same has been reported by NVDA in the recent FQ1 2026 earnings call, with data center revenues of $39.1 billion, negative 9.8% quarter-over-quarter, plus 73% year-over-year, along with overall adjective gross profit margins of 61%, negative 12.5 points quarter-over-quarter, negative 17.9 year-over-year, negative 0.7 from FY 2019 levels of 61.7%. Despite missing out on the $2.5 billion in additional H2O revenues attributed to the new export requirements. For now, aside from the potentially intensified chips ban, readers must monitor the headwinds arising from hyperscalers, which have increasingly adopted custom AI accelerators for improved cost inferencing performance ratio. For example, fabless semiconductor companies such as Broadcom, AVGO, and Marvell have reported expanded hyperscaler partnerships and subsequently growing top-bottom line performances, with the former already highlighting an estimated FY 2027 AI serviceable addressable market (SAM) size of between $60 billion and $90 billion, with it defining a potential target market size a business can reach. Given the potential overlap between their hyperscaler base and the subsequent top-line erosion, it is unsurprising that NVDA at 52.5% has lagged behind AVGO at 70.8% in terms of their stock price recovery after the recent April 2025 bottom. On the other hand, we beg to differ, since NVIDIA's AI accelerators are likely to remain in great demand, attributed to their general-purpose AI solutions. Compared to custom AI accelerators designed for highly specific hyperscaler AI training purposes. At the same time, readers must note NVIDIA's true trump card, the CUDA platform. With the parallel computing platform and programming model for their proprietary GPUs, AI accelerators, presenting the company's true moat by locking in developers' enterprises into its ecosystem. With CUDA commanding over 90% of market share for AI compute platform, it is unsurprising that its direct peers, including Advanced Micro Devices, AMD, and Intel, INTC, have previously struggled to penetrate the highly exclusive segment despite their open-source models, combined with the vertically integrated businesses across networking solutions, hardware, NVLink software, new CPU offerings, and CUDA-X libraries, amongst other things. We believe that NVIDIA is likely to remain the king of the AI boom, thanks to its undisputed CUDA moat. These reasons are also why NVIDIA's Blackwell remains in high demand, with it driving a 73% year-on-year increase in data center revenue. Blackwell contributed nearly 70% of data center compute revenue in the quarter, with a transition from Hopper nearly complete. Despite the prior overheating issues, that's why the management has felt confident to offer a promising FQ2 2026 revenue guidance of $45 billion, plus 2.1% quarter-over-quarter, plus 50% year-over-year, despite the hefty negative $8 billion in H20 revenue loss arising from the export limitations, which otherwise may have boosted its FQ2 2026 AGD growth rates to plus 13.8% quarter-over-quarter, plus 76.6% year-over-year instead. These developments demonstrate the robust hyperscaler demand for NVIDIA's proprietary AI accelerators. With it apparent that the cloud market is more than big enough to accommodate multiple platforms. The consensus forward estimates. These reasons may also be why the consensus forward estimates remain highly promising, with NVIDIA expected to chart an excellent top-bottom line growth at a compound annual growth rate of plus 30.1%/30% through FY 2028 respectively. This is compared to the prior estimates of plus 20.2%/22.4% a year ago, albeit maturing from the 5Y historical growth profile at plus 64.2%/64%, 83.2%, and 10Y growth at plus 39.5%/55.8% respectively. NVDA valuations. That's why NVDA continues to appear attractive at forward PE non-GAAP valuations of 33.55x, thanks to the discount from the 5Y mean of 47.30x, while nearing the 1Y mean of 34.33x, the 10Y mean of 36.25x, and AVGO at 37.78x. Thanks to the robust bottom-line growth prospects, we believe that the stock remains relatively cheap at forward PEG non-GAAP ratio of 1.16x as well, compared to the sector median of 1.75x and the 5Y mean of 1.79x, albeit somewhat inflated compared to the 10Y mean of 0.64x. The latter development implies that a moderate pullback to our buy zones may be necessary for an improved return profile, one that we shall further discuss in the next segment. So, is NVDA stock a buy, sell, or hold? NVDA 5Y stock price. For now, the bulls have already defended NVDA's bottom at the $94 ranges, with the stock breaking out numerous resistance levels and the 50, 100, 200-day moving averages. Based on the LTM AGD EPS of $3.19, plus 77.2% sequentially, and the FWD PE non-GAAP valuations of 33.55x, it is apparent that the stock is trading at a notable premium compared to our fair value estimates of $107. Even so, based on the consensus FY 2028 AGD EPS estimates of $6.57, there appears to be an excellent upside potential of 53.2% to our long-term price target of $220.40, despite the recent recovery by 52.5%. NVDA's likely reversing momentum. Even so, We believe that NVDA's buying momentum has seemingly peaked at current levels, with the stock likely to stagnate at current levels barring any positive catalysts, based on the technical indicators observed above. Given the developing trade war situation, the stock's failure to break out of prior heights, and the volatile geopolitical environment, we believe that interested investors may be better off monitoring the stock price movement for a little longer before adding. This is preferably upon a moderate retracement to NVDA's prior support levels of 130s and 122s ranges for an improved margin of safety, with it implying a minus 12.4% downside at the midpoint from current levels. Patience may be more prudent in the meantime. This article was written by Juxtaposed Ideas.